market that we believe will be very, very accretive to our larger picture. Coming to the UK market, what makes this attractive for us, aside from the obvious aspects of being a stable country, a developed country, clear rule of law, business certainty, policy certainty, and things that are more, common across various industries. For us, particularly in the business of private healthcare, it is very reassuring to know that across political cycles, irrespective of which party or which orientation was in power, the role of the private sector in being a key pillar of addressing the healthcare needs of the country has been widely and universally acknowledged and is now seen more as a matter of fact and one that will take on an increasingly important role in the years to come. Within that industry as well, we are also comforted by knowing that there have been meaningful success stories with the other large operators, many of which, or I would say most of the top large players, are owned by international multinational corporations or international investors. So this is, we find an interesting market which not only has growth potential, but which is stable in its broader conditions, which has a track record of other operators who are doing wonderful work and who have seen good success, as well as a long-term future where we can build essentially a multi-decade business scaling and operation. Within that market, within the UK, we considered several assets. Some of you may know, or over the years we've spoken or had, fairly early discussions with a whole range of providers, some whom are very small, some whom are very, very large, and some in between. We believe Practice Plus fits into the sweet spot in terms of its size. If the asset is too small, then there's not much we as NH can do to add value. At the same time, if it's very, very large, there are certain other complications where it becomes unwieldy. There are other complexities in running that. In terms of size, this is a good sweet spot where we believe it is large enough for us to not only own 100% of it, but large enough for it to have the critical size for us to make a meaningful difference with what we bring to the table, which I'll come to shortly. Yes, we also note that this asset has certain aspects of the business in terms of its payer profile that are meaningfully different than other peers. We see this as an interesting opportunity. There were certain assets we considered that had a very, very privately oriented payer mix, which is great from a profitability standpoint, but that also leaves less room to improve and less value for us to. For us, that we buy a business which has a management with a proven track record that is safe and secure with the new ownership, and we're happy to report that the fantastic management, the entire senior leadership of this organization, is going to be staying with us, even though we are buying only one division out of the three. It's a company with three divisions. We're just buying the hospitals division, but we've secured and aligned the key people in the senior management, and we're very confident in our ability to work with them. And they're very bought into the larger vision of what we bring to the table as well. I'm just going to request Mr. Rakesh to go on mute, please. Yeah, so to continue. So we're very confident and eager to get started with the management team under new ownership. And this is the capable group of people who've been running the business so far. And we feel that there is all the ingredients in place for us to essentially make a good attempt at replicating what we've done in Cayman, but on a much larger scale and in a much larger market. So I think that's addresses the two largest questions we got, which is why the UK and why this particular asset. But also happy to get into the question and answer session and answer any specific questions or take this any other direction that you guys want. Nishant, maybe we can start
the Q&A.
Yeah, sorry, Sandhya, go ahead.
Q&A, I just wanted to clarify one more financial point, which wasn't there in our earlier deck. So the numbers which we had shared in our deck earlier was pre-IFRS. So when we reported 20 million as the EBITDA, it was pre-IFRS, which means after adjusting the lease costs. So if we take the like-to-like post-IFRS EBITDA, which is before the lease costs, it is 29 million for FY25. So we have since added this in the deck, and we will be uploading the revised deck shortly.
Nishant, how do you want to do this?
Yeah, so we can start the Q&A session now. We request everyone to now use the raise hand feature to start posing the questions. I think we already have raise of hands from Ravindra. Ravindra, can you please go ahead?
Hello, am I audible? Hello?
Yes, you're audible.
Yeah, we can hear you.
Yeah, this is Ravinder from Bangalore. So I'm a retail investor. Actually, see, over the weekend, I got hold of the annual report of the acquired company, right? So I was going through that. I have few questions around that. So firstly, I want to clarify that we are going to acquire only the hospital division, that's the secondary care division. Am I right?
That is correct.
Right. Okay. So I'm looking at the revenue for the financial year ending
This meeting
24.
is being archived.
Okay. So as per that, the revenue in terms of Indian rupees is around 2,660. It comes. I'm taking an exchange rate of 116. Okay. So it's in million terms, it's 229. That has been reported from in the annual report last year. So in your deck, I think the numbers are not matching as such. That's the one thing. So am I correct on that?
Yeah, we're happy to take that question offline. Nishant
Because
and the team will reach out to you to
yeah,
reconcile the currency conversion.
not just currency conversion, it's 229, and also the EBITDA numbers, everything looks very, very different. Because I'm looking at the annual report of the reported company.
Sure.
Okay, so based on that, I have a few questions, right? Because I think it would have been better if the deck had been prepared with the updated numbers so that it could reflect real value of the company as such. Because when I calculating all the numbers, for example, the secondary care margins, it's coming around 11.8% for me, based on the annual reported numbers of September 2024. So when we look at the deck, it doesn't give me that bullish stance as such. Right?
Ravindra, if I may, the thing that was announced was of the overall holding company, yes? The one with 3 business verticals?
Right. I'm just taking the secondary care.
No, we understand. Yes. The thing about disentangling a business that has 3 verticals into one is that there will be cross charges. There are certain things that reflect across multiple balance sheets. So the company is in the process of disentangling, which may lead to slight adjustments here and there. As we close down this process over the next quarter and so, we'll be able to give you a much better picture of the hospitals only business. But right now, the businesses within themselves also render services to the subsidiaries. And so that may be part of the reason why some few million here and there may be a discrepancy. But as far as the audited numbers that we have, this is what is there. But the next quarter will give us a much better picture.
What we have given you, Ravindra, is in our deck, what we've given is the carved out financials that has been diligenced by our diligence partners and extrapolated for the full period. So therefore, this is the number that we will be acquiring and integrating with our balance sheet. What you see in the public domain has, like Viren said, other than hospital data also mixed up, and therefore you will not be able to reconcile it. You should take the number we are presenting as the correct number.
Because they have bifurcated everything. So that's why I'm having this question, because it gives a lot more bullish stance than what has been reported. I don't know, but it should have been better that if you had
Any other
taken.
questions, Ravindra?
Yeah. So if I again, going on, I have a few questions. Say, for example, what happens to the liabilities on books? So how much liability? Because you, as you say, you're taking only one division.
Yeah, that's fine. We can answer this now.
Yeah. So Ravindra, we are, other than the liability for the leases, there is, and the regular liabilities for creditors, we are not taking on any liability on our books. So we are acquiring the company on a debt-free basis. So whatever liabilities you are seeing in the balance sheet, which is uploaded in the company house, those will be left behind. Only the regular creditors and lease liabilities we are taking over. This also answers Rushabh Doshi's question on the chat.
Okay, that means that term loan as such will be repaying or will not be taking over the term loan as such. That's what you're saying.
The seller will take care of the repayment. We are
Okay.
acquiring the company on a debt-free basis.
Okay. So again, if I take that point, it's giving a very bullish stance as such. So, okay.
Any other questions, Ravindra?
I think what about the dividend distribution as such? Because company has been paying regular dividends. Is there any stance on that, like how that will be accounted
Yeah,
for,
we
whether
can answer
we
that.
get some part of a dividends as such?
We can
Yes.
answer that.
So our current plan, we do intend to continue with our current dividend policy,
No,
which
I'm
we
not
have.
talking about the NH as such, because this company has been paying a dividend regularly. Last year, they paid around 34 million as a part of entire company. So we are taking a part of the company. That means there is an embedded dividend within that. So as there has been
We
any
haven't taken a
arrangements.
call yet on what the intercompany dividend would be between the subsidiaries and the main. We are still in the process of merging and acquiring these companies and consolidating the account sheets and taking over the finance department. We will have a much better sense of this over the coming quarters. But as of now, it will be hard for us to comment.
Okay, fine. Apart from that, yeah, actually I had a lot of numbers related since you.
It's fine. Maybe we can move on to the next person. And if the queue exhausts, you can join back again.
Sure. Yeah, thanks.
Thanks, Ravindra.
Yeah.
Prithvi, can we have a question, please?
Yeah. Anish, just, a couple of questions. Obviously, the first one, you mentioned about UK saying stable government or, stable policies, growth, track record of international investors, etc. This might be the case with even other European nations, right? So why particularly UK? How is UK market different, or, what kind of growth levers are you looking in the UK market?
Sure. So we did consider other opportunities in various other markets. So just with regards to the country itself, there is we see a track record of every larger, if you take the top 5 healthcare providers, barring one, which is a not-for-profit, the others have demonstrated consistent growth in revenue terms, as well as in earnings with some volatility. And they're all owned by international investors as well, for the most part, barring one or two. The second thing is that in terms of the total health spend, the percentage contributed by the private sector is still in its infancy. There is, we believe, a long journey ahead and meaningful change that could happen in the decades to come. So if you combine the entire spend by the private sector, it's approximately 16 to 17% of the grand total. So it is still relatively the benefit of a low base. Having said that, it's not just the market that is the country; it's also the asset. There are certain other markets that also have certain similar favorable dynamics or certain other favorable aspects. But it's also a question of identifying the country as well as the asset within that country that fits our criteria. And for most part, Practice Plus within the UK was a good intersection of many things that we were looking for.
Okay, got it. So you're mentioning that the country might incrementally move from NHS to private, and private sector will benefit from that.
It's not something that one would obviously be able to predict in the short term. There are periods where it's taken the other way as well. If you look at historically, there are periods when the dependency on the private sector increases. There are periods where it decreases. But for the large part, we think that this is a relatively low base, so there is certain safety that we're not going to see a drastic reduction in the levels where it is right now, because we don't want to be fighting against the headwinds of a decreasing, shrinking market. That's always hard to do. So from that perspective, this is an option we narrowed down on.
Got it. And one of the key reasons why Cayman has done exceptionally well for you people is that you were able to replicate more or less Indian cost structure for the international realizations. So how should we look at UK? UK, how about the laws there? Can you import equipment from India? So how does the entire cost structure work? Also, because the hospital is currently at 8% EBITDA margin, how do we look at margins, in a 3 to 5 years down the line?
Sure. So just addressing the comment on Cayman, we do have clinical as well as non-clinical staff from every other country as well. But even if to the extent that we are able to take people from India, we can't pay them an Indian salary, obviously. They earn just as much as they would in any other equivalent opportunity in that market. So we're not looking at essentially an on-site labor arbitrage opportunity in healthcare services. That's very difficult to do. So, for example, for decades now, India and other South Asian countries have been sending thousands, tens of thousands, in fact, of nurses to the UK, and obviously they earn just as much as any other nurse. So it's not, the reason we were able to drastically alter the cost structure in Cayman and have a lasting competitive differentiation in cost compared to peers in the region is because of the entire ecosystem of operational changes we were able to begin, which is all the most part underpinned by our technology platform, which does scale across markets. So we run, as you know, in Cayman, we operate on an entire technology platform that's built and owned by us that gives us the opportunity to perform every single transaction with far fewer human touch points or far fewer people involved and far less steps than competitors. So whether it's a revenue cycle process of processing an invoice, whether it's processing payroll, whether it's admitting or discharging patient, every individual process is done with fewer touch points. And when you add it all together, we just get a very different, simpler, leaner operation. We think a lot of this is replicable in the UK. Obviously, the scale is different. The market is larger. We have to go through that learning journey in Cayman. It took us a while to get there. That was also the first time we were doing that. We're confident we won't take as many years as we took in Cayman. But you are right in the broader sentiment that with what we've done in Cayman, which is meaningfully alter the cost structure on the backbone of our technology and other broader capabilities, that's also what we hope to do in the UK. And through the process of our diligence on this asset, we've developed a good degree of conviction working with the management as well that this is possible. So we had senior members of their team come to Cayman, see what we've done, and really pressure test that the hypothesis that can we replicate this or largely replicate this in the UK. And there was unanimous agreement that many elements of this, what we've done in Cayman from an efficiency standpoint, can be replicated here. Of course, they have to be adapted, but directionally, I think you are right.
So if I have to ask you for a number, right, some broad-based number, say 5 years down the line, once you implement all these things, how should we look at EBITDA margin as well as revenue growth?
Yeah, I think it's a little, very, very early margin. It's early days for us to comment on that. We hope to develop a view that we'd be happy to share in the years, in the quarters to come when we meet next time. But I think for now, the direction that we have is we are internally quite confident that there are advantages we bring to the table, both in the path they are on. They've started many things even predating us. So even if we did not close this transaction, they are already at an inflection point with certain investments and changes they are making to improve their revenue trajectory. And we're lucky to be entering at the right opportune time.
Okay, so let me put it this way, if you have to look at ROC, right, eventually, everything has to translate to returns. Given that, it's such a large investment and you have India as an alternative market, so what kind of ROC are you looking at?
Yeah, so our conservative, base case is by FY 29-30 or so, we want to be, in the range of 20 to 22% from an ROC perspective is where we see. And a lot of that is driven by, the entry price, which we know, certain assumptions around the trajectory the company is on, as well as certain assumptions around the difference we can bring to the table. But, we are more, we wouldn't have entered this if that wasn't a high conviction thesis that we had that by FY 29-30, approximately in that range, we'll be within the 20-22% ROC level. As you said, for the reason you said, because of the alternative opportunities for us. Yeah.
So one final question before I get back into queue again. Will this be, after assuming the interest cost for the entire 150 million GBP debt, will it be EPS neutral in the first year and then it will turn positive, or will it be earnings dilutive in year one?
Yeah, there's a little bit of nuance to that question. I'll hand it over to Sandhya to walk you through that our thinking there.
So as far as EPS is concerned, it will be neutral, maybe mildly favorable also in the first year. How it picks up from there, we'll have to see based on the performance of the business.
Okay, that answers. I'll join back in the queue.
Thanks, Prithvi. Thanks, Prithvi. Harith, can we have your question, please?
Hi, good morning. Thanks for the opportunity. In the presentation, you've talked about attracting more private pay patients. So currently the mix is around 93% coming from NHS. So if you can talk about how this mix has trended over the last few years, and do you expect this to change or improve materially in the next few years, and what are some of the steps that you're looking at in terms of attracting more private pay patients?
Yeah, no, thank you. So if you just look at the competitive landscape, so if you look at the only publicly listed asset that's available where robust data is there, so Spire. So Spire currently has about, as of the recent half year, about 35% of their payer mix being NHS, the rest combination of self-pay and PMI, which is their private medical insurance. The other assets have, the other equivalent assets at Circle, which is ADQ owned, around the similar range. Ramsay Health, which is, I would say, closer to PPG than the others, has about between 60 to 70% NHS. So Practice Plus is definitely an outlier, being at 93, but this is a factor of where they've started off the journey in the origins of the company and where they've trended. So to your question on, they started up being 100% NHS. This movement to 93 is a little more, 93 is a little more recent, and it is our intention, as well as the management's intention, which point they erst were on the trajectory to increase the percentage of their payer mix from private sources. And we are definitely going to enable that journey. It's a little hard to give you, a hard number as to where we'll be in 6 months and the year, etc. It's still early days for us. But that is definitely the intention, and they've taken some very concrete steps and decisions, not just on individuals, but also on asset selection and certain assets they've recently acquired as well to enable that.
Okay. And within the NHS part of the business, given pricing is set by the government, what are the steps that we can undertake from a margin improvement standpoint?
So it's a very fair system, to be honest. Broadly, in a nutshell, NHS England would pay you, that is a private hospital, the same as they would pay themselves, which is their own hospital. And this is also largely inflation linked, accounts for changes in wages. So, aside from HCA, which is, I would say, next to zero NHS, all the other players that are privately owned as well as publicly listed do vocally state that, there is a role, a meaningful role for an NHS in a broader payer mix, because it is stable, it is secured, it is sustainable, and it is largely inflation linked. So it's not something that we would individually do to influence reimbursement, etc., because we're just a very small cog in a very large wheel. But in terms of improving margins within an NHS framework, you have all the levers of cost around cost structure and operational efficiency, because in some way the price is set to be largely sustainable or close to sustainable for the government themselves. So as long as we can execute on a strategy that improves our day-to-day operations and our cost structure, and differentiates ourselves compared to peers, both public and private, then the profitability, even being a predominantly NHS payer mix, starts looking very, very different from what it is now.
Okay, one last one, more of an observation. When I look at the specialty mix, it's skewed towards orthopedics, and I understand that NHS backlog could be a reason here, and the high number of elective procedures in the ortho specialty. Are there any other specialties where you think a similar dynamic exists, where there's a high proportion of elective procedures which you can target, and then you see as an opportunity?
Yeah, that's the right way to think about it. So the existing specialty mix, not just for us, for other private providers as well, is largely reflective of what the NHS chooses to outsource, as well as their backlogs and the other factors as well. So this is a lot of heavily skewed towards orthopedics, ophthalmology, general surgery, these kinds of things. There are certain other services and specialties where other providers have a good chunk of their revenue mix coming from, which Practice Plus doesn't. So that's a easy opportunity for revenue enhancement without any additional investment in infrastructure. So to your question, there are several services that we've already identified where it is possible to start in the existing infrastructure without adding hard infrastructure, just some operational execution and some people and teams and clinical orientation. We definitely will be assisting the company to start these services and grow within the same property footprint.
Got it. Thanks, Anish. I'll get back in the queue.
Sure.
Thanks,
So
Harit.
three
Raman,
questions.
can we have your
First
question?
is, I just want to understand. It's more or less like a follow up on the previous participant's question. So majority of our revenue comes from NHS. I just want to understand the payment cycle, and are we shifting towards? Is there any plan to shift more towards private players? And because my understanding is the margin mix between NHS and private players have better margins. So if you can help me clarify that.
Yeah,
Sure,
I'll take
sure.
that question.
Yeah, go ahead.
So in terms of payment cycle, NHS pays within 15 days on an average. So the company almost operates on virtually zero working capital. As far as the private pay piece is concerned, I think Anish just explained to the previous speaker the dynamics around that. So I think that question is answered.
Okay.
Yeah, but happy to essentially just answer quickly. Essentially, yes, you are right. The private payers do pay a rate like for like basis that is more than the NHS, but each has its own attributes that would make it attractive. And a good mix between all would be the ideal outcome. And to your question on whether our intention is to increase the non-NHS sources, that is PMI and self-pay, yes, that is our intention. And we hope to make good progress on that.
My second question is, our total bed capacity is 330 beds. Acquiring entity. What's the operational bed out of this?
So they're all operational. In fact, the way the market is oriented there, because the procedures are more shorter stay, day care, lower in acuity. Unlike in India, which is the market we're all familiar with, the bed isn't the fundamental unit of measuring capacity, etc. There are other units that are more reflective of capacity. So yeah, in our parlance, when we say capacity in operational beds, all these beds are operational. Yeah.
So are we having any capex to increase the bed number of beds?
No, we don't need to increase the number of beds because the bed wouldn't necessarily be the bottleneck or the driver of throughput or capacity. But in the current footprint, we don't anticipate any capex being spent on a bed addition.
And to the larger question of can the existing infrastructure do more, the answer is yes. There's scope for significant throughput enhancement, both through the existing specialties, adding more volumes and adding more bolt-on specialties.
Yeah.
And my final question is with respect to the Birmingham Center, when will it achieve break-even?
Yeah, Raman. So, that's a center that was recently acquired by one of the other peers as part of a merger and disinvestment. So it's in a great location. The center is our newer center, I would say the newest center. It's still in a sort of a pre-commissioning phase, and that's why you have operating losses. Some aspects are commissioned, some haven't. We hope to update you and the rest of the callers maybe in a quarter or two once we get a better sense of where we are in that. Yeah.
And so I just have one question with a technical question. What's the difference between center EBITDA and adjusted EBITDA?
Yeah, so essentially center EBITDA would just be the profitability at the business unit in aggregate, combining all the business units. But then between the center EBITDA and what we would finally land up with is our corporate costs, things like our IT contract, central staffing, payroll, everything that forms a central shared service. These hospitals, unlike what we see in NH in India, in isolation, are small units. They're relatively small. So a lot of their costs are shared across the entire organization. So that would be the difference. Sandhya, you want to add anything there?
Yes. So there are divisional overheads and corporate overheads that come between the center and the adjusted EBITDA. The only item on the adjusted EBITDA is the adjustment for the Birmingham losses, which we have called out. Other than that, the adjusted EBITDA is equal to the EBITDA as we measure pre-IFRS and NH parlance.
Sure. Go to the next one.
Yeah, Kaustav, maybe you have a question, please.
Sure. Firstly, congratulations, guys. I think it's very heartwarming to see an Indian entity make global presence, and so kudos on that. I have a couple of questions. The first question is, NH in India is known for its focus on throughput, the DNAs of throughput, which is very counterintuitive to the industry versus what the other peers track, right? What will be the would it be essentially the same kind of DNA and focus that you guys will be able to implement in the UK entity? And what will be the benefits that you guys can derive from integrating Atma, which is your tech stack, in the UK acquired entity? Is there any quantitative versus qualitative target or some projection you guys have made internally to determine the benefits that come from integrating Atma?
Thank you, Kaustav, not just for your initial kind words, but for asking our favorite question. But yeah, so one reason we like this company is because there is a very good philosophical alignment and match in terms of the importance of operational efficiency and throughput. So I will call out an important fact about this company that we really, really admire. There is no private provider at this scale and above, so they may be smaller, but at this scale and above that we know of, that can operate at a 93% NHS payer mix and have the margins that this asset has. So even before we come in, this is a management throughput that understands the value of simplifying processes and automating either with software or with other interventions, and that's very much how we like to think of it. So it is very, very heartwarming to see that, and that really attracted us to this company, because we're not trying to bring in a very large culture change. We're just enabling them with our platform, with our tools, with what we bring to the table to just turbocharge what they're already doing. So to your second question around the Atma technology platform. Yes, absolutely. It's very similar to what we've been able to do in Cayman. We believe that in time, hopefully sooner than later, we are able to infuse our technology and digital capabilities to automate away things that don't need to be done, to simplify the way a lot of processes happen. In markets which like Cayman, like the UK, like Europe, there are many steps to take a patient from admission to discharge that have nothing to do with the clinical care, that have nothing to do with their disease or it's just administrative steps and functions to either record the care, document the care, and get paid for it. And this is ideal fertile feeding ground for us to come in with our broader capabilities and what we've already built to identify opportunities for improvement and efficiency.
Splendid. Thanks for that. My next question is, in India, Narayana is known to be one of the most efficient and most capable hospital for robotic surgeries and robotic capabilities. Do we have any plans, or if you can comment on the same robotic surgery capabilities of the UK entity?
Especially the complex care, organ transplants, open heart surgery, etc. In the UK, for the most part, there are exceptions in some of the London hospitals, but for the most part, the private providers are doing work that isn't that high in acuity, but they're doing it at scale, at throughput, largely helping the NHS with their backlog. So your robotic work, your organ transplants, these kind of things would still tend to happen in the NHS, not in the private sector. So it's a meaningfully different level of acuity that we would see either compared to Cayman and India. And there's nothing wrong about it. It's just the nature of the market, and we're happy to identify where we can add value in terms of enhancing the scope of services they have with our clinical background. If it leads in a direction where it advanced work, so be it. But I don't think that will be the initial focus.
Sure, got you. My next question is, Is price discrimination subsidizing the lower end of the pyramid? Is it even relevant in UK given it's a developed market with essentially wealth distribution that is not as skewed as India? So is price discrimination subsidizing the lower end of the pyramid in terms of customers? Is it possible? Is it on cards for you?
No, that's not really how it works, because the NHS has essentially, a tariff that you get paid. You don't decide that. That's what you get paid. You can obviously influence volume and quality, etc. But that's a centrally decided tariff. There are self-pay patients, which are essentially like in India, they're paying cash.
Right.
They're shopping around because they don't want to wait on a waiting limits. Then on the other end, which is privately insured, again, it's like in other markets where you have a negotiated tariff with the insurance company and the patient is not responsible for that. So in the non-NHS, there are two buckets, self-pay and PMI. In the self-pay bucket, there is some element of what you're saying, but it's not that as prevalent. But in PMI, it's also a fee schedule.
Understood. Fair enough. My last question is, since we already have been operating in Cayman, which is a UK administered territory, and now we're in UK, do we have any benefits in terms of our regulator? Do we at all have any benefits in that direction?
I don't think so, because they're differently regulated. I mean, Cayman is a British overseas territory, but that doesn't flow down in any meaningful way in terms of clinical regulation. Of course, all providers in the UK are wonderfully regulated by the CQC and related bodies. And it's a very robust, time-tested, fair system in our experience. And another good attribute about this company is it's one of the, in a good group of, a select group where every asset we operate, every unit is rated good or excellent by the CQC, which are the top two ratings. So every asset that this company operates is good or excellent. So they're doing a phenomenal job with regards to their regulatory requirements and compliance. And we definitely look to continue that.
Amazing. That's all of my questions. Thanks for answering, and congratulations once again.
Yeah, take the next question.
Yeah, Ramesh, please go ahead.
Amish, I think already asked.
Ramesh is already asked. So we'll move to Shivam. Shivam, can we have your question, please?
Sorry, if we could just request, if anybody has asked their question and wants to get back in the queue, if you could lower your hand, please, and then raise it again so we can keep track of who's next. Thank you.
Yes, Ramesh here. I haven't asked a question yet.
Yeah, Ramesh, go ahead, please.
So, just to understand the transaction.
We're not able to hear you, Ramesh. Can you please be a bit louder?
Just hold on. Can you hear me now?
Not well, Ramesh.
Just hold on.
Yeah, it's fine. But go ahead.
Yeah. So if you look at your overall transaction cost, is it all in cost? Is there any other adjustment you expect? And in terms of other charges and asset valuation, everything is included in this valuation?
Yeah, Nishant.
Sandhya, you want to take that, Nishant? Yeah.
The cost is all in cost. However, typically, as is in every deal, there is a 4 to 5% deal cost which comes for diligence, for stamp duties, for lawyers, etc. So that will come on top of the costs that we have indicated.
So this cash cost is already paid, or it will be done in the second quarter?
In quarter 3, yes. We will pay. We have signed, we have not closed. Closing will happen by end of week. At that point in time, we will make the payment.
Okay, fair enough. So that means your 3Q results will show the consolidated impact of this acquisition, right?
Yes. From the date of closure.
Okay. So if you look at the value of this acquisition, now obviously you possibly have done the homework. You would have possibly assessed similar acquisitions elsewhere in the world or in India. So have you also considered similar acquisition opportunities in India? Because that's your home market. That's the reason why I'm asking this question. And why is the private equity firm which has owned this asset selling out? Is it just because they're catching in on their value over the years? Or is there any other structural reason why they are getting out? Because the NH itself has been going through a lot of political debate in the UK. So So yeah, in terms of your own value proposition, what is it that you're adding to that business, and why is the existing investor selling, if I may ask?
So the second question first, Ramesh. The investor is Bridgepoint, which is a UK private equity fund. They reach the end of their life cycle. So they have to return money to the investors and they need to offload this asset as well as the other two that are part of Practice Plus Group. So that is why they are selling and that's why we are taking up. To the question that you asked first, are we looking at opportunities in India? Yes, of course. We look at opportunities constantly in our core markets. We've identified quite a few. We've tied up with real estate developers. We bought land. We are building in Bangalore, Calcutta, Raipur in the projects that we've disclosed. And here and there, M&A opportunities do come up. But a lot of the time, private equity-backed M&A opportunities in India tend to be priced very, very aggressively. And in all the valuation, in all the calculation that we make, the payback tends to get quite stretched. And so that's why it's still something we do consider, but either they are too small and not that we're able to do much with it, or the few opportunities that get written about in the newspapers, the ones in India, are beyond our ability to afford.
Okay, so if you look at the manpower cost for the UK assets, about 39%, doctors plus the others. What are the controllable levers you have in terms of pension liability? And given that, there's also a currency risk involved. So when you look at your overall ROC target, have you built in any, increase in this manpower cost, assuming that, the consumables and the other operating expenses, something which possibly is within your control. And to the extent to which, you're talking about the NH patients, accounting for more than 90%. So is all the increase in the cost built into this, overall revenue mix? And to what extent can you make up any, increase in margins required to the self-paying patients?
Yeah, Anish, if we can talk about the inflation-linked tariff, please.
Yeah, so to Ramesh's first question, the composition of the P&L to various cost heads is not very different from what we see in India or in other larger markets. And to you, as Viren mentioned, the NHS sets its tariff the same for all providers largely, and it does reflect a tariff increase does reflect the cost of inflation of medical goods, wages, and other services. So there is that element of being insulated from that. That's also passed down to the private insurers as well with some delay.
So is it fair to assume that your Indian asset is that UK asset is going to be something of an annuity business over time?
It's a bit early to say that, but let's address that maybe in a couple of once we're settled in there. Yeah.
Okay, thank you very much and wish you all the best. Appreciate it.
Thank you. Thank you very much.
Shivam, can we have your question, please?
Yeah. Am I audible?
Yeah.
Yeah. Workers in UK. And given that the NHS isn't very keen on letting people come from outside, what stance do we
As a
have on
private
that?
provider, you're slightly more insulated from the workforce shortages compared to the public employers who have a lot of other factors to consider and wage constraints. So for the most part, because of the acuity of services not being tertiary and above, and because of the attractive workplace that private workplaces offer compared to public workplaces, the larger shortage is not that much of a concern for the private sector, and particularly for PPG.
Okay. And given the NHS is very tight on their budget, do we have a process in which we can get away from the NHS payer mix?
Yeah, so we answered that previously as well. The intention is to move away with certain changes that have been made on the ground with regards to people as well as asset selection and marketing efforts. We'll continue to do that, and the intention will be to increasingly attract more private and self-pay patients.
The way we have started the insurance, providing insurance in India, will we be doing that business as well?
No, we're just entering as a provider now, and it's still early days.
Okay, sure. Thank you.
Thank you.
Thanks, Shivam. Shreyans, can we have your question?
Yeah, hi. I had a couple of questions. So the first one is, if you could give of the 330 beds, what's the kind of utilization currently for the beds?
Yeah. So as earlier mentioned, bed isn't the unit of utilization. There are other capacity levers about theater sessions and theater utilization. But if you take beds as well as theater, other metrics of utilization, it'll approximate to closer to 50 to 55%. So as Viren mentioned, there is adequate room to accommodate additional volume in the same properties.
Got it. Got it. So since it's 50 to 55%, so trying to understand what stops us, given the backlog that NHS has, from increasing this utilization, and why is it, at that level?
So backlog doesn't translate into NHS willing to pay for it. They need to have funds to pay for it because the backlog largely exists because they do not have the funds to render the services within their own property or to pay for it in the private sector. So that is one constraint. And also the intention would be to attract non-NHS patients as well. And that, like in any market, whether India or otherwise, has its own learning curve about understanding the patient acquisition journey. It's more consumer choice because they can go wherever they want, and addressing those those levers.
Got it. Got it. And my last question is, so by when do we expect, the tech systems to be integrated into the UK, into the hospital?
It's a journey. So we'll start immediately with low hanging fruit. Certain things that are easier to do, but certain core systems will take more time, a couple of quarters, maybe longer than others. So it's a journey, and it won't be one date when systems transition. It will be module by module, application by application, and the benefits will we hope correspondingly flow incrementally over the years as well.
Got it. Got it. That's all from my end. Thank you so much, and all the best.
Thanks, Shreyas. Nidhi, can we have your question, please?
Yeah, sure. Hi, thank you so much for taking my question and congratulations on the strategic partnership. Hospitals versus NHS, and who would be our targeted audience, our targeted customers?
So sorry, Nidhi, could you be a little more specific, please? What do you mean by ecosystem for private hospitals? Sorry about that.
So when we talk about all the major services being catered by NHS, and what type of services we would be catering to.
Yeah. Okay. So largely, the biggest success story in private outsourcing is ophthalmology and cataracts. That's well served. The others would be what you'd expect: orthopedics, a lot of joint replacement, arthroscopy, gastroenterology procedures, general surgery, etc. These would be the more, think of anything that's elective, short stay, and is not life-threatening or critical. It's not an emergency trauma and things like that.
Right. And fundamentally, what would be catering to over a longer period of time, given that we are going to reduce our dependency on NHS to catering to non-NHS segments? Like, who would be our, audience with regards to the cash payment patients, or is it going to be more on insured size where corporates do not have coverage on those insurances where they are going to cater the services?
If I understood your question right, the non-NHS typical patient profile is somebody who has private insurance. This is in the country largely, for many people, employer provided, for some individually purchased as well. I think that's fairly similar to what we see in India as well. So those would be, that kind of person would be the target demographic.
Right. And just the last one on margin side, our consolidated margins would be diluted with this acquisition. So even on a longer term, let's say we are able to achieve 8-9% or maybe 10% kind of margins, which the industry is catering at the moment. How do you see this planning on a longer term? Where are we going to find a pace on our consolidated books?
Yeah, Sandhya, you want to take that?
Yeah, it's a forward-looking view we don't want to give, but we have given a certain idea on how we look at the next 12 months margin in the deck that we have shared. We're hoping that we can build on that and improve on the margins. Anish spoke about all the cost and efficiency levers that we have. So over a period of time, we will have to build on these levers. But we have shared a kind of an indicative number in the deck we have put up for the next 12 months.
Right, got it. Thank you. I'll get back in the queue.
Thanks. Now we'll go to Niranjan and Kapil because Ravindra, Pratik, we've already answered, and we'll get back to them again. But Niranjan, can we have your question, please?
Niranjan, can you hear us?
Maybe we move to Kapil and come back to Niranjan.
Yeah, fine. Kapil, can we get your question, please?
Yes, please. I would just like to get some more clarity on the answer relating to the impact of the acquisition on consolidated EPS. Now, just considering the present profitability rate of Practice Plus Group, and after considering the interest to be borne on funding costs, would this acquisition to the EPS be mild or moderate or more? If you can please give some indication.
Broadly flat, if at all mildly positive.
I see. All right.
That's it, Kapil?
Yes, please. Yes.
Thank you. Damayanti?
Thanks.
Yeah, hi. Thank you for the opportunity. Just want to understand, you are getting already established doctors team there, and the incremental update which will come from this transaction is that you will bring in more efficiency. So 2 points. So you don't need to add on any doctors, even you don't need any infra in near term. And just with the existing capacity which they have, you try to bring in more technology to drive the growth. Is my understanding correct? At least this should be the setup in medium term.
Largely, but once we get in and understand more about the market, if there are interesting opportunities, straight off the bat, we will look at starting other services, new services within the same properties, which would require new doctors. But if there's anything, the company has been exploring certain other opportunities as well, and we'll evaluate them as and when we get settled in.
Okay, so there is like good headroom to add on more services, and for that you might need to expand your team a bit.
Yes.
Okay, and just from the segments or categories which is currently served, you mentioned about few segments. So from NHS outsource work, will that be the key opportunities which will continue, or you think since the backlogs continue to increase at the NHS, you can see more businesses coming in other categories as well?
No, I think the services that usually form the bulk of what private providers do is fairly known and constant. Of course, certain things may change here and there, but not in the short term.
Okay. And my last question is, what will be the key offering to you when you target more of these private or self-funded patients, apart from, they don't have to wait for the treatments, which is a case with NHS. But from your perspective, what will be the key pull factor, if you can help us understand?
Sure. So for the private patients, the competition isn't the NHS; it's other private providers, and the standard. Importantly, we believe that cost either to a private insurance, to a PMI provider, or to a self-pay patient, cost of treatment is something they're very, very sensitive to. So if we are able to meaningfully lower the costs and offer an equivalent quality option at a meaningfully different price, then that becomes very interesting. Even in markets where Practice Plus is successful in attracting private patients, they're doing so at a price advantage to the others, and we hope to continue to build upon that.
Yep. And my last point is the other players who are in the private space. I understand they might be also investing a lot in technology, right? So what will be the key offer from you? Because in market like Cayman, I understand you are the only player, right? That's why your focus on technology, etc., could lead to great results. But maybe in the UK market, things are very different on the competition part.
Yeah, Cayman, so we're not the only player. We wish we were the only player in Cayman. No, there are others, but it's a small market. So there are a few other players. You are right. UK is a much larger market. So in different locations, obviously there are going to be more players. Yes, like anybody, any business, they continue to invest in technology, and some of them have very good systems. And we believe that the efficiencies that we are able to derive, we hope will be better than the competition. But let's see.
Okay, this is helpful. Thank you, Anish.
Thank you so much.
Can you move to Niranjan now?
Yeah, Niranjan, can you hear us?
For the previous question, you mentioned we are planning to increase the.
Niranjan, we're not able to hear you.
Hello.
Okay, maybe you can type the box, Niranjan. We'll move on to Alankar.
Viren, what do you want to do about the questions on the chat? Should we address them
Let's
offline?
finish up. No, we'll finish up the queue and.
Okay.
Alankar?
Yeah, hi, good afternoon, everyone, and congrats on the acquisition. So firstly, you spoke about increasing the private mix gradually over NHS. You also spoke about margins. Can you comment a bit about the growth aspect for PPG? Asking this question because if you look at the 5-year CAGR, it was about 12%. If you look at the last 2-year CAGR, it's about 9%. So did PPG see any COVID-linked bump up in the earlier part of the 5-year cycle? And is the 9% growth which you've seen over the last couple of years, is it more indicative of what the asset can deliver without any significant increase in the private contribution?
Yeah. So thanks, Alankar, for the question. So, COVID did not play a meaningfully different role compared to usual for this asset. Having said that, they are on a growth trajectory, like you said, which was in the longer term 12 to 14%, nearer term 9%, with their existing payer mix. A lot of that depends on. By the way, none of this is with adding sites except the Birmingham, which is not yet operational. They've been largely static with the number of sites. So this you can consider as the organic growth year on year. We see no reason why that should slow down. In fact, there are certain interesting opportunities with adding more services now that we are involved within the same properties that would further build upon that. But it's still early days. We'll get a better grip of the growth that we can expect to see on a shorter term year on year basis, maybe in a couple of quarters.
Understood. The second question is more on the transaction. Actually, two questions there. Firstly, how should we look at any broad split between goodwill and intangibles?
It is too early, actually. We are still working through with the auditors. We have just signed the transaction. After closing, the auditors will go through the details and then we'll have a better view of this. So we are not in a position to answer this question at the moment, but we will answer the same as soon as we have better visibility on this.
Got it. And the final one, apart from the 150 million pounds debt, will the rest of the acquisition be funded entirely by Cayman's balance sheet?
The entire acquisition is being funded by Cayman balance sheet. 40 million is going as equity. The rest of it is a leveraged buyout, and therefore it is a debt on the books of the target.
So no India balance sheet cash will be used to fund the acquisition?
No.
Okay, understood. Thank you. That's it from my side.
Thanks, Alankar. Niranjan, would you like to speak or?
Yeah. Am I audible to you?
Yeah, go ahead.
Yeah, for the previous question you mentioned, we are planning to increase the non-NHS part, right? What are the strategies and plans for increasing the non-NHS part?
Sorry, strategies for increasing?
The non-NHS
yes.
patient mix. Yeah.
That has been answered already. I think just in the interest of time, maybe we'll move on to the other questions. Any other question, Niranjan?
And also one more question is in the PPT, it is the 4th largest player, right, in NHS. And also for other 3 players, what is the percentage share of non-NHS part?
So that also we answered previously. Yeah.
Thanks, Niranjan. If we can go to Ravindra, please.
Yeah, hello, am I audible?
Yeah.
Yeah, thanks for the opportunity once again. So this is one kind of a broader question. As per the last year's annual report, there is a cash on books for in the company around 600 crores. Sorry, for 400 odd crores. Is there any arrangement between the parties that how this cash to be used, or do we get any benefit out of this deal to NH?
We are
for
acquiring the
cash in?
company on a zero debt basis. There is working capital of about 5 million that is being left behind in the company. Other than that, the rest of the cash and the debt will be cleared by the seller.
Thank you.
Okay, that's fine. Just one last question. What's the interest cost that we are we're going to operate off for this acquisition for like 150 million, as you said? What would be the interest
We
cost?
have borrowed at about SONIA plus 200 bips on an average.
Okay, currently I think they are having 6.25%. I think it's a floating rate interest rate. That's what they are operating. So do we have
Their
any?
interest rate is not relevant for us because we are acquiring on a debt-free basis. So we are acquiring at a SONIA plus 200 bips kind of range.
What would be the ballpark figure just for
Sonia plus 200 bits revenue.
6 plus 6
Okay,
or 6 or.
Okay, okay,
Yeah.
more or less the same.
In the
Thank
interest
you.
of time,
Okay,
if we
thanks.
can move on to Prithvi Viren.
Yeah, Prithvi.
Thanks. I just have a couple of questions. One, going forward, if you have to move cash from Cayman to UK, for capex, etc., is the cash taxable, and what will be the tax rate?
So equity is not taxable. At the moment, we do not intend to move cash from Cayman. The target is sufficiently cash flow positive to take care of its own capex requirements.
Okay, got it. Second, Viren, obviously it took 7-8 years for you to get into another geography. Can we assume that, for next few years, the focus will be on UK, before looking for something else?
If you're worried about our inability to stick to one geography, please rest assured the UK is a very large market. There's a lot of learning that we have to make, and there is tremendous scope for growth. We are pursuing still in the Caribbean opportunities there because it is highly synergistic with the Cayman hospital that we run, as well as in India, which is our core target market. Whatever we're spending in the UK is small compared to how much we're planning to invest in India in expanding our core market here. This came about because we see a good opportunity to grow in a developed country where there's a very large and growing need for private healthcare. So we can't give a commitment on 7 to 8 years, but just that we've made a commitment here and we will continue to invest in this.
That's clear. One final question. Anish, you mentioned about Spire Hospital, that has 35% payer mix from NHS. If I look at margins, they make close to 18% kind of EBITDA margin. Is it fair to assume that, that's something that you will look for this acquisition, maybe in 5-7 years down the line?
Yeah,
if
so
the
there
payer
is
mix changes.
Yeah, so I think the more fair comparison would be to say to best in class, like say Circle, which has the same capital structure, which is all leased asset. Spire has half their assets, approximately half owned and only half leased. So one would have to account for a lease effect, which I think you've not done to arrive at that figure. But yes, I mean, to the broader question, I think that there are other competitors in the market operating at a meaningfully higher level of profitability, accompanied with a different get there sooner or just as much.
So sorry to squeeze in, one more question. What will be the realization difference between NHS and a private insurance and a self-pay in UK?
Yeah, it's a good question. It depends on location, who the hospital is, who the insurer is, but broadly, for many procedures, PMI would pay anywhere from 20 to 30% more than NHS. But it just depends. These are individual contracts. These are it's not publicly available, but it's just a broad industry guidance. This is a consensus number.
Okay, that's
Thanks,
helpful.
Prithvi.
Thanks, always.
Nitin, you get the last word.
Thank you so much, and congratulations, team, for a very interesting acquisition. Just a couple of housekeeping questions to start. One is from a capex perspective, with the plans that you have right now, how much capex did you envisage any meaningful capex for the business over the next, say, 3-4 years?
Yes, the business has regular routine maintenance and refurbishment capex, which the business will continue to incur. Will be in the range of 10 to 20 million every year, but that's baked into our financial plan.
These businesses are fully asset light. All the buildings are leased from private lessors as well as the NHS. And a lot of the equipment is leased as well. So the growth will happen in a very capex light manner.
Are we, I mean, obviously very early days for you, but for example, the Birmingham Center is there. Are we on the lookout for adding centers over the next short term, or is it going to happen over a period of time?
And it's a bit of both. Anish can talk about
Yeah.
the consolidation and expansion.
Yeah, so the Birmingham Center is something that is yet to be fully commissioned. We're eagerly working towards that. The management has looked at certain centers, but nothing that is imminent or that can happen right away. These are things we'll look at. There are one or two opportunities, but as Viren mentioned, these are structured from a capital structure perspective, very different from what we're used to India, where they're very, very light and loaded towards the end, just pre-commissioning when you're bringing in medical equipment. And they're largely leased, and that appears to be how the industry broadly operates there.
And Sandhya, what kind of cash break-even period do we looking at for this transaction? I mean, how many years do we start to sort of cash break-even from an investment perspective?
So it's a leveraged buyout. So we are positive that we will be able to pay for the loan that we have taken on the books of the target from the cash flows of the target itself. From an IRR point of view, it is crossing our threshold IRR, high double digits. So with that, I think you can understand the payback because it's not a number we are officially disclosing, but this I think gives you an idea.
Perfect. And from a PBT perspective, when do you think this transaction on its own starts to make a meaningful impact to our consolidated numbers?
From the first quarter of integration, full integration, it will be significantly material in our consolidated number. But from a PBT point of view, it will take maybe 2 years because of the margin profile of the rest of the businesses.
Something like F28 or thereabouts.
Yes, yes.
Okay, thank you so much.
There are a couple of questions on the chat. A lot has been answered. I will skip those. In terms of how does this align with NHS global expansion and delivery priorities? Highly in sync with our value system, and it is a growing market, and it is a place where it is stable, where it has a very strong and secure market. The question about are we planning to do cardiac care or oncology? We are not ruling it out. As of this point, the Practice Plus does not offer cardiac care nor oncology. It offers more general surgery. It's something we'll definitely be in discussions with the NHS as well as with the existing service plate, but the buildings are simply not configured for this sort of work. So on the existing asset base, it may not. As we get more comfortable, both in terms of the leverage this has and what expansion would actually look like, we would consider other service lines. The EBITDA margin guidance.
So we have given a next 12 months broad guidance in our deck itself for the pre-IFRS EBITDA. The lease costs you can assume similar to what is there in the balance sheet today because there aren't any additional lease costs that are coming on board. So that will give you a post-IFRS indication. But those are indicative numbers. We cannot give forward-looking guidance.
So this is a good question. How much of the NHS contract influences or constrains the growth of operations? The answer is it doesn't constrain. This provides the base of every hospital, which assures you a level of break-even. Everything we do above that is either through volume growth in more NHS contract revenue, adding more departments, or increasing the private pay business. So it is a very useful thing to have for the entire hospital group, and it is something we won't materially alter. In fact, we'll try and grow as much as we can, but private pay and other service lines add on top of that. Nidhi's question, what percentage can afford private hospital services? As of our understanding, in London, it is slightly higher, but across the rest of the UK, it is much lower. Anish, is there any, do we have a percentage figure that's publicly available?
I mean, not in that exact sense, but the amount of people who privately access care has been steadily growing over time. But what we'll be really looking to do is lower the cost of self-pay care and PMI care, and hopefully that improves this number.
The next question is, what is the component of absolute depreciation for the acquired entity?
It's about 8 million pounds.
And the net assets that we'd be acquiring?
About 30 million pounds. The rest are the right to use assets.
Yeah. The next question is on impact on near-term EPS. We said it's slightly positive to neutral. Vinay's question, is there correlation between NHS waiting list and hospital capacity? I think Anish answered that. The waiting list is more in terms of ability to pay. The NHS waiting lists are because they are challenged in the current way the whole thing is structured and their ability to pass through. It does mean that there is an assured business, yes, because as a more efficient, low-cost operator, the NHS would be very happy to partner with hospital groups like us to be able to clear the waiting list. And it's something that we will continue to grow on. The debt level and console level.
Sure. So we have given the debt that we're taking on the books for this acquisition. We've also given the long-term debt plan for India and Cayman. We are in silent period and we cannot disclose a forward number at the moment, but I think you can calculate with the data that we've made available.
As for the question of other QIP plans, as we mentioned earlier, there is no real need for it now, but it's not something we will rule out at some point in the future, because we do not want the debt level to constrain our expansion, provided it's done in a measured and conservative manner. Yeah.
Okay, so are there no more questions? We would like to conclude our session. Thanks, there's one more question on the chat.
Whether Tamil Nadu is an expansion. So
comment right now on the NH business strategy because we are in silent period. So if you have any specific questions, please dial into our investor call in 2 weeks from now, and we will answer questions relating to NH's strategy.
But if you have a hospital in Tamil Nadu that you'd like to sell us, then please get in touch.
Okay, thank you, everyone. Please feel free to reach out to us in case if you have any further follow-on questions. Thank you.
Recording stopped.